So the stock market averages 10% a year, but what happens if I invest my money into the next Sears and a company goes bankrupt? Then I lose all my money. And so this is where you have to know the different ways that you can invest your money in the stock market, and you can invest your money into an individual company like, say, Amazon, AMZN. But when you do that, you're carrying on all the risk. Now you have to put in the work to analyze the stock, keep up with the company, see if the company is growing, and if Amazon does very well, you get to see the profits because now Amazon stock will go up and you can get rich. But if Amazon doesn't do good, and Amazon starts producing bad products, and they manage their cash poorly, and they have a bad CEO, well, now the company could go bankrupt, and now you lose everything. And the question is, do you want to be involved in putting in all the work, effort, time, and research, or would you rather invest your money more on autopilot? I'm not going to decide for you. Both of them are great, but what I want you to understand are the different ways that you can invest your money, because a lot of people think that investing in stocks is trying to find the next Amazon, and that's why most people end up losing money. But the real opportunity for so many people isn't by trying to find the next Amazon, it's just by owning a piece of the United States economy, because there are funds out there that will give you exposure to the American economy, and we know that the American stock market has grown by 10 to 12% a year for the last number of decades on average. I'll show you what I mean. Instead of investing in Amazon, another thing that you can consider is something like VTI. VTI is an ETF created by Vanguard. Vanguard is a money manager, and this is an ETF that gives you exposure to the total stock market, which means if you go onto your stock brokerage app, there's a ton of them out there, and you buy one share of VTI, you're buying a little piece of all the stocks in the American stock market. You're buying a little piece of thousands of American companies. Now, you're not trying to pick the perfect company. You're not trying to time the stock. All you're doing is you're buying pieces of the American economy, and if the stock market goes up, VTI will go up. If the stock market's going down, VTI will go down. We know markets go up and down, but if you hold on to this for the long term, we know that markets generally go up over the long term. But let's assume you don't want to be so broad. You want to be a little bit more narrow. Another example here is SPY. SPY is an ETF that gives you exposure to the S&P 500. You may have heard that term before. The S&P 500 is a group of the 500 largest companies in the United States stock market. So now, instead of going out and buying all 500 of those companies, you can just buy one share of an ETF like SPY, and it'll give you exposure to those 500 largest companies. Now, if Amazon, who was part of the S&P 500, starts to struggle and they're no longer part of the S&P 500, well then SPY and the other ETFs would kick Amazon out and replace it with another company. This way you don't have to worry about managing the fund. It's managed through the fund. You find the right fund and then it will manage the stocks for you. Now, we do got to give a little disclaimer because investing has risks. You're never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube. Everything that I talk about is for example purposes only. But let's take this one step further, assuming you want to get even more granular. Let's assume you're like me and you like investing for cash flow. In the stock market, some companies pay out dividends. A dividend is a cash payment that a company gives you for doing nothing except owning the stock, and generally they pay you this money every 3 months, meaning every quarter. Well, there's an ETF out there called Noble, N-O-B-L, that gives you exposure to dividend-paying companies in the S&P 500 that are dividend aristocrats. What does that mean? Number one, they are in the S&P 500, meaning they are a part of the 500 largest companies in the stock market. But it's the ones that are paying out dividends, meaning the ones that are handing out these profit distributions every quarter, but they're also dividend aristocrats, meaning that they've been paying out dividends every year and increasing their dividends for the last 25 years or more. And now I'm going to take one final step further. Let's assume you want to get more granular with your investments. You don't want to invest in the broad economy. You want to invest in the growing elder population in the United States, because you assume that because baby boomers are getting older, there's going to be more money going into that elderly care field. Well, there are also niche ETFs out there that can give you exposure to really whatever you want. This is just a random topic that I picked, and there are ETFs that can give you exposure to those niches. For example, Aging, AGNG, is an ETF that gives you exposure to the companies that are providing care to people that become older. So as more people become older, certain companies will profit. This ETF invests in those companies. So when you want to invest in the stock market, you can invest in individual companies, or you can invest in funds that pick the companies for you. And now you can decide if you want to be broad in the total stock market, broad in the S&P 500, broad in dividend paying companies, or very niche. But I can't talk about investing without talking about real estate because I got my start in the investing world in real estate. And the way real estate investing works is you're gonna go and buy a property. Let's assume a single family house, but now you're not buying it for you to live in, you're buying it to rent out to somebody else. And the mistake that a lot of people make is they assume that they're gonna have to pay money out of pocket every single month to own this property. But if you do it correctly, the way it works is you're gonna buy this property and then have a tenant move in there. Now they're a happy family because they get a nice place to live, and in exchange, they're going to pay you rent every single month. And now when they pay you rent, if you do it correctly, this rent is gonna pay for all of your expenses, your property taxes, your insurance, your maintenance fees, your management fees, and your vacancy costs, and then put some money in your pocket as cash flow. Now, you might think that this is going to be extremely difficult. Well, it is when you get started. But after you get over the hump of learning the game, it can be a lot more passive. The first few years of me getting started in real estate was extremely difficult, extremely time consuming, and very stressful. But after I learned and after I found the right team members, now it's very passive on my end because I have a very good property manager. They're giving me reports every single month. I can see in real time which properties have been paid rent, which properties are behind, what maintenance has to be due. I can see everything in real time, but it takes time to learn the game and to learn how to do it profitably. But the nice thing about real estate is, number one, you can get this monthly cash flow because when you start stacking properties, well, now it starts to add up and you can live off of that cash flow. Number two, you own a hard asset because I own properties that I can see, feel, and touch. I own the land, which is nice because when I own a share of, let's say, Amazon, I just have a piece of paper that says I have a share of Amazon. I can't actually do anything. If I walked into the Amazon factory, well, nobody would know who I am. And then number three, with real estate, you also get some of the biggest and best tax breaks that our tax code has to offer. As a licensed attorney, who's not your attorney, what I can tell you is that wealthy people love real estate for the tax breaks because when you invest in real estate, you can make money and pay little to no money in taxes legally because of the deductions that you get as a real estate investor. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.